Now, if you're a new investor, you've likely heard the terms bull market and bear market. These terms are so confusing that they're rarely explained, even by those using them. They clearly refer to different types of markets and economic conditions, but what do those terms really mean? And how can you navigate the two market conditions? In this episode, we'll explain what a bull market and bear market really are, and more importantly, how they can affect your investment portfolio. Once you learn the difference between the two, you'll be on your way to learning how to invest like a master. But before we go too far, don't forget to hit that subscribe button so you don't miss our next videos on the type of stocks to buy during bull and bear markets. So let's learn about bull and bear markets in detail. What is a bull market? A bull market occurs when the prices of assets are on the rise for a certain period of time. Investors who believe that prices will increase over time are known as bulls. As asset prices rise, investors begin to develop confidence, which tends to draw in further investment, causing prices to continue to rise. As an example, consider the 2009-2020 bull market, which was the longest in stock market history. After suffering price reduction as a result of the 2008 financial crisis, the S&P 500 lost value in March 2009 and then proceeded to climb until early 2020 when the COVID-19 pandemic sent stocks crashing. Now that you know what a bull market is, let's quickly explain what a bear market is. What is a bear market? A bear market is the opposite of a bull market in every way. Bear markets are defined as a period of time where asset prices are falling and investors' confidence is low. Investors who believe asset prices will continue to fall are referred to as bears. Bear markets can be difficult to trade in, particularly for new traders. Bear markets can last from a few weeks to several years. The first and most famous bear market was the Great Depression. The dot-com bubble in 2000 and the housing crisis of 2007 to 2008 are other examples. It's difficult to predict when the bear market might end. This is because rebounding is usually a slow and unpredictable process that can be influenced by different factors, including investor psychology, economic growth, and news or events in the world. A bear market can present opportunities. After all, if your investment strategy is longer term, buying during a bear market can pay off when asset prices begin to increase. Investors with shorter term strategies can also be on the lookout for temporary price increments. And for more advanced investors, there are strategies like short selling, which is a way of betting that an asset will decline in price. Another strategy many investors employ is dollar cost averaging, in which you'd invest a set amount of money, say $50 every week or month, whether the asset is rising or falling. This distributes your risk and allows you to invest through bull and bear markets alike. Differences between bull and bear markets. There are lots of differences between a bull and a bear market. Some of the differences include stock direction. The market is mentioned as bulls when the overall market scenario is positive and the market performance is on the rise. A bearish market is when the performance of the market is on the decline. Investors' confidence. In a bullish market, the investor's outlook is very optimistic, and this is visible from the fact that investors will be investing for the long term. This way, the anticipation is that asset prices will rise further, and investors have an opportunity to maximize profit opportunities. Conversely, in a bearish market, the market sentiment is quite discouraging, promoting investors to invest for the short term. Economic conditions. The economy grows sustainably in a bullish market. In contrast, in a bearish market, the economy will either fall or not grow at a faster pace, as in the bullish outlook scenario. In both these situations, an indicator like the GDP, gross domestic product, plays a vital role in how the economy performs. Employment data. The job market in a bullish situation is very bright, and there is more money in people's pockets. However, in a bearish market, the job market is stiff and efforts are being made to control expenses rapidly if the situation is not improving. Liquidity. In a bullish market, there's more liquidity and investors will continue to pump more funds with increased trading activity. Investors are also likely to invest in stocks, gold, real estate, etc. Still, the liquidity dries up in the system in a bearish market, and investors are reluctant before making any commitment. The investments made during a bullish scenario are either sold, preventing any losses, or holding back to them for future usage. IPO activities. IPO activities are encouraged in a bullish market since the market sentiments are positive and investors are willing to invest more money. However, in a bearish market, initial public offerings, IPOs, are avoided since investments will not be encouraged. How do bull and bear markets impact investors? Well, if you're a true long-term investor, you shouldn't really be too concerned with whether you're in a bull market or a bear market. The bottom line is that in the history of the stock market, the long-term trend is up. If you're a long-term investor, the up and downs of bull and bear markets will cancel out. Although they can be scary at the time, they don't have a big impact on your portfolio. Bull and bear markets will only affect you if you give in to emotion that the markets can cause financial damage. The best way to combat the up and downs of the stock market, which are inevitable, is to stay the course with your long-term investment strategy. Of course, this doesn't imply if you're close to retirement or plan on drawing from your portfolio for any reason in the next few years. Investing in stocks is a long-term process. If you need money for a down payment for a house in the next year, for example, keeping your money in the stock market is risky at best. What to do in a bull versus bear market? In a bull market, your best bet is to take advantage of rising prices by purchasing stocks early in the day, if feasible, and selling them after the market has reached its top. Any losses should be minimal and brief during a bull market, and an investor may normally actively and confidently invest in additional equities with a better likelihood of achieving a profit. In a bear market, however, the risk of losing money is higher because prices are constantly falling and the end is rarely in sight. Even if you decide to invest in the hopes of a rebound, you're likely to lose money before the market recovers. As a result, the majority of the profits come from short selling or safer assets like fixed income securities. Defensive stocks, on the other hand, are those whose performance is only slightly influenced by market movements. Furthermore, in a bear market, investors may gain from investing for the short term and benefit from declining prices. Investing in bull and bear markets. Because there are so many changes between bull and bear markets, how you make financial decisions differs significantly. In a bull market, having a bigger investment is ideal since the potential for high returns is greater. Buying stocks early and selling them before they reach their peak is one strategy to profit from a bull market's rising values. Investing in the stock market in a bear market, when there is a greater risk of loss, should be done with caution since you're likely to lose money, at least initially. It's a good idea to put your money into fixed income assets if you're anticipating a bear market. While it's critical to understand market direction, predicting when a bull market will turn into a bear market is extremely tough. Long-term strategic asset allocation has proven to be the most effective technique for handling market changes over time. Working with a financial advisor to build a diverse investment portfolio can help you navigate volatile markets and make reasonable rather than emotional investing decisions. Both bear and bull markets will have a significant impact on your finances, so it's a good idea to spend some time researching the market before making a decision. Keep in mind that the stock market has always produced a good return over time. That's it for this episode. Please give us your feedback in the comment section below. To watch more episodes on financial topics like this, hit that like and subscribe button. Now, if you want to support us even more, buy us a coffee from the link in the description. Good luck and see you in the next episode.